GPT.
Welcome back, investors. Welcome to a new video on our YouTube channel. So today's video, the topic is in fact ETFs. Even though I'm not an ETF investor, I do have a lot of students actually who think about maybe not only doing stock picking, but they would like also to invest into ETFs. And I have receiving very often questions about what are the things that I have to pay attention to when I invest into ETFs. So I would like to make a short video to really give you like the keys to understand and read what are the risks related to ETFs. Before that, I wanted to thank you actually because now after kind of 6 months, we have reached already 1,000 subscribers on our YouTube channel. So we were today, I think, 1,018. So it's growing like by, I would say like 5, 6 every day. So I would really like to thank you, which is like growing so fast. I think this means that you like the content that we are providing. And in case you are not a subscriber, follower yet of our YouTube channel, Value Investing with VinGPT, of course, please be so kind and register to the channel and hit the notification bell so that you get notified when we publish new videos. All right, going now into the ETF. So the three types of ETFs and the conversation that we're going to have is around physical, synthetic, and leveraged ETFs. But first things first, very brief perspective on why today a lot of people are looking into ETFs. Well, first of all, ETFs, like many other financial instruments, has been in fact created by financial markets a certain amount of years ago. And the first ETF was launched in North America, I think it was in Canada, in early 1990s. And they actually became very popular now in the 21st century. And today I'm going to give the statistics. 12% rough cut of the financial instruments across the world are linked to ETFs. But I will show the statistics and the growth that we have had year over year on the ETFs across the world. One of the reasons also why ETFs became famous, and you see here a book that actually you may see behind here in my library, which is the 1965-2004. And I have seen there is a more updated version of the letters to shareholders of Berkshire Hathaway, but I have this one, so I didn't want to cheat on what I'm showing here. So in this book, so in 1996, because I read this book and all the annual shareholder letters that Warren Buffett has been writing to the shareholders of Berkshire Hathaway. So in 1996, actually, Warren Buffett said, and allow me to quote him, "Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees." So he was basically saying, if you're not interested in becoming a business owner like a value investor, and I do have always between 8 to 12, currently I have 13 companies in my portfolio, I consider myself, even though I'm a minority shareholder, a small shareholder, I do consider myself a business owner of those companies. And so Buffett said, of course, and I've learned this from Warren Buffett and Charlie Munger, this requires reading the financial reports every quarter, so it requires some homework, so you need to have the time to read into this. But he said basically, I mean, if people don't have the time or they're really not interested in understanding markets, they better maybe just buy an index like, for example, the S&P 500 in the US that has been providing something like a 11-12% average return pre-tax on an annual basis. And so I was right now mentioning one type of ETF. In fact, the underlying assets can be an index like the S&P 500. So you have a lot of ETFs that kind of track. This is why also ETFs are very often called trackers. They do track, in fact, just a stock market index. They may track, you have ETFs that track commodities, that track currencies, that track specific industrial sectors. I'm going to give you one example of a high dividend yield ETF at the end as well when I'm explaining how to analyze it very briefly. It's not the intention to go into all the details here. You have ETFs that track industries, bonds, etc. So, I mean, there is nearly an ETF for anything in this world today. So there is really a wide selection of ETFs. And I will show also who are the largest ETF providers today. As of May 2024, I really tried to find updated figures. So what I could find is actually, and this is JP Morgan in terms of source, there are rough cut 12,000 ETFs that are listed globally, which represents around $13 trillion of assets under management. And I mean, it's growing compared to the previous year, 2023, that was a little bit more than 10 trillion. And when you look at the growth, what I just mentioned a couple of minutes ago, when you look at the growth, and here this the source Morningstar of December 2023, you actually see, first of all, that there has been a strong growth. So you see that the graph has been growing. So this was the 2023 figure. May 2024, we were already at 13 trillion of assets under management. And you see that there has been a linear growth in this. What is interesting as well when you pay attention is the color coding here. You see that most of the ETFs are in fact linked to equity, so public equity or public listed equity companies. So yellow is fixed income. That would be typically probably like government bonds, sovereign bonds, corporate bonds, maybe municipal bonds for the US as well. Then you have commodities, very small, miscellaneous and alternatives. So there potentially you will find currencies, for example, this type of thing. But you see there's a steady growth of people in the world actually investing into ETFs and flows of money flowing in fact, those type of instruments. What I wanted to show as well, so here I've picked up a report from State Street. And so what is interesting, so they show a similar growth, in fact, on the amount of, let's say, the percentage that ETFs represent globally on total investable assets. So they confirm that rough cuts, we have today 12-13% of all investable assets globally, which are invested under the form of ETFs. What is interesting as well is that of those 12 to 13%, more than 10% are passive ETFs, meaning that there is no human which is basically intervening in the ETF. So they are, for example, just tracking a stock index, which of course allows to have a very low cost structure versus less than 1%, or let's say 1%, which are active ETFs. So there probably somebody is managing the portfolio and what the ETF is actually tracking actively as a human. So in terms of largest ETF providers, I think it's also important to understand what is the market share and who is actually, let's say, dictating the market. Is it a very concentrated market in terms of ETF providers? Well, yes. So the first one, and again, thanks to Morningstar for providing this data points. So you see that the largest ETF provider is iShares, so that's basically BlackRock, and you see that they have rough cut 1 out of 3 ETFs in the world is actually sitting with BlackRock. Then you have Vanguard, very close, so very well-known ETF provider as well. State Street is also a very big one. So 1 out of, let's say 1 out of 6, 1 out of 7 is with State Street, and then Invesco. And then you have smaller ones like Charles Schwab, which is probably most known in the US, maybe a little bit less in Europe. You see the JP Morgan's, Fidelity, which is, for example, very well known in Europe. So you have some ETF providers, but you see actually and I've calculated here just for those who are interested, the C4 concentration ratio of the market, because this is a market with products, with revenue generating activities and with margin. So you see that the C4 concentration ratio is 79.8%. So it's a very, very concentrated market amongst a couple of actors worldwide. And I mean, if you would look at the history, don't have the time to go into it, but you would actually see that those very big actors, they have been attracting a lot of money inflows because they have been drastically reducing the fees by being passive ETFs instead of active, and through that they could reduce the fees. So today you have fees that are by far below 0.5% on an annual basis, for example. But not all ETFs are equal. This is something that, so first of all, understanding what ETFs are, where they're coming from, but not all ETFs are equal. And there are what I will call, or what is called, different replication methods, which carry different levels of risk actually. And this is what I share with my students and let's say colleague investors as well. But that's something that I wanted to share with you as well. So if you categorize the main, let's say, 2 categories of ETFs, there are actually 2. This is what we call physical ETFs and synthetic ETFs. And I will add then a third one, which is leveraged ETFs later on. So if you're interested, and the European Systemic Risk Board actually published a very nice report. They have not published an update since 2020, so since 2019, if ETFs can contribute to systemic risk. And I found this, I mean, I read this report already many years ago, as we are now 2025. And I found it very interesting to look at the perspective how the European Systemic Risk Board looks at ETFs potentially being a source of one of the future, let's say, triggers for a global crisis. I mean, if you would ask my opinion, I would say that yes, specifically synthetic ETFs could be one of those instruments, but I have no clue. So you know me, I'm not making any forecasts. But indeed, it's something that I'm not the only one having the feeling that yes, indeed, ETFs could contribute to systemic risk, and synthetic ETFs specifically, and you will understand why in the upcoming minutes. So the difference, and I will not go into the technicalities of it, but the difference between a physical and a synthetic ETF is that the physical ETF, to make it simple, an ETF provider that tracks the S&P 500, if it is a physical ETF that is being sold to the market, actually the ETF provider guarantees that the assets are bought on the market, meaning that if Apple represents, I have no clue, 7% of the S&P 500, that the ETF has 7% of the ETF that is represented by Apple stock, actually. This is what we call a physical replication or cash-based ETF. Synthetic ETF are actually, and this is why I consider them more risky, and I'll give you a risk management or risk profile overview at the end. I mean, they are not, in fact, buying the underlying assets, so they are not replicating physically the assets that they pretend to track, but basically they engage in a collateral agreement, what is called a total swap return agreement with, for example, a bank. So the bank guarantees them that if the ETFs goes up and down, or if the underlying assets of what they claim that they are tracking, if they pay out dividends, that the bank will provide those dividends to the synthetic ETF provider. So, and this is where actually, and you will see this later on, this is where, if you look at bullet point number 2 here, the red one, this is where actually the counterparty risk comes in. Because tomorrow, if you have a default from the counterparty, from the bank, well, actually, I mean, the synthetic ETF will not function. And I mean, there are no underlying assets. So this is really a financial risk of potentially investing into such synthetic ETFs. So, I mean, trying to compare left to right, what are the underlying principles? So what I already said is that physical or physically replicated or cash-based ETFs, as we call them, they do indeed possess the assets of the index that they track, for example, the S&P 500. Synthetic ETFs, they don't actually. So synthetic refers, in fact, to the fact of replicating synthetically or artificially the returns through derivative instruments like total swap returns. What is the purpose? Well, the purpose for physical or cash-based ETFs is basically that investors can easily buy and sell one basket. If they want to invest into the US market, like the S&P 500, they can very easily, just buying one instrument, which would be an S&P 500 ETF or tracker, they can actually invest just into the US market. Or if they want to invest just into high dividend yield paying companies, there's going to be probably an ETF provider that has those high dividend paying companies under one single instrument instead of having to buy the stock separately. For the synthetic ETF, sometimes there is a valid purpose, which is that sometimes the underlying securities, for example, in emerging markets, are very difficult to have access to, or the cost to acquire them is actually pretty high. So sometimes, I mean, it makes sense sometimes to have synthetic ETFs if you want to have access as a US investor to a emerging country stock exchange, but the cost is too high. So maybe there it would maybe make sense to go through a synthetic ETF where probably the fee structure is going to be much lower than buying directly or trying to buy directly those stocks, for example, through an over-the-counter transaction. So the operational mechanism, as I already said, and I'm going to show you that in physical replication or cash-based ETFs, there are actually two types. Most of the people are doing sampling, not full replication, specifically when there are many companies that the ETF is tracking in its index, because, I mean, you have to understand that there are so many fluctuations every year or every day, that becomes actually very complicated to follow exactly. So maybe just a sampling method that does not, let's say, create too much risk is also a very valid method for physically replicated or cash-based ETFs. For the synthetic ETFs, as I said, I mean, the ETF provider engages in a swap agreement, typically with a bank, And of course, there is some collateralization. So of course, both parties have to provide some guarantees. But of course, I mean, some regulators, they are worried about synthetic ETFs because there is maybe lack of transparency, because like this swap agreement, I mean, we are not aware what is inside that swap agreement, right? So the primary risk when you compare both big categories of ETFs is that the primary risk on physically replicated or cash-based ETFs is just, I mean, market fluctuations. We all know that markets are volatile every day, actually. And I'm a public equity investor, so companies provide new financial, let's say, reports or financials every quarter. There is daily volatility on public equity markets, and you're going to have the same on bonds, on currency, on commodities linked to geopolitical things as well. So this is, I mean, where there is a clear risk. On the synthetic ETFs, as already mentioned, the risk is on the counterparty. So if the bank involved in the swap, so typically a total swap return type of agreement or derivative instrument, if the bank goes default, I mean, this is where you have a counterparty risk for your investment. So one thing that I like, also as a value investor, just to share my perspective on this, and this is also coming back to if I would have, because I've been asked by investors and also my students why I don't invest into ETFs, because for the time being, and I shared this in webinar 17, I do have a 23% annualized return that I'm measuring since 2017, which I think is not too bad, 23% realized gains on an annualized return perspective. In fact, I consider that synthetic ETFs are actually something similar to the flow, a little bit similar to the insurance floats, how Warren Buffett actually received money for free to become, in fact, very wealthy. And I have a lot of respect for Warren Buffett, do not get me wrong. Because in fact, in terms of capital efficiency, it's very similar. It's like using leverage and optimizing the external capital to generate returns. So it's not identical to insurance float, but it's similar. It uses similar, let's say, capital efficiency attributes. So as I said to my other investors or students that have asked me, if I would have to invest into an ETF, I would definitely invest into a physical ETF or cash-based ETF and not into a synthetic one. But again, that's just me. This is not now a solicitation for you in case you would be a synthetic ETF owner to sell, for example, the ETF, right? I'm just very transparently sharing here with you what is my perspective. By the way, one of the things when I was discussing with some of, let's say my community and the investors that are part of my community and students as well, I actually, when I was discussing with them in a webinar, I asked them, who of you is reading actually and knows if you are invested into an ETF, if you have invested into physical or synthetic one. And actually it was very interesting and eye-opening that, and I believe that my community is a pretty, let's say, serious community, because I mean, they're coming from the value investing world. I mean, they pay attention. It's not the typical speculator or trader type of profile. And I was actually surprised that actually 1 out of 2, when I was asking them during the webinar, they actually mentioned that they were not aware and they were not reading the prospectus of the ETFs. So that's also one of the reasons why I decided to do this video. Even though I'm not invested into ETFs, I'm only invested into public equity stocks. So I'm a stock picker and I'm a value investor. But I wanted actually to do this video just to, let's say, make sure that also, let's say, my community on YouTube pays a little bit attention to what type of ETF they are investing into, at least in my humble opinion. So we saw the differences between physical ETFs and synthetic ETFs. I'm going to show you then later on concrete examples of an Invesco, of a BlackRock ETF. But also one thing that we have to discuss is leveraged ETFs. What are leveraged ETFs? So it's a different type actually of ETF, which can be linked again to any type of asset. And the idea is in fact to create an instrument that provides a multiple return of the index or the basket of assets that it is tracking on a daily basis. Typically, what we currently see on the market is we have what is called 2x or 3x leveraged ETF. So what does it mean? And actually it's very interesting because I have the feeling that the regulator is obliging an ETF provider to, in the title of the ETF, to put 2x or 3x, and you're going to see this later on. But basically what a leverage ETF is for example, if the index increases by 1% or the underlying basket of assets, that a 2x leverage ETF will then have a rise of 2%. 1%. This is what 2x basically means. But of course, conversely, it means that if there is a 1% decline in the market, that your investment is going to go down by 2%. And of course, you understand it's the same for when it is a 3x leveraged ETF, that if the market raises 10%, you're going to have an increase of 30% on a daily basis. But if the market goes down 10%, you're going to have actually a reduction of minus 30% on your investment. So actually leverage ETFs are pretty popular among short-term traders, which is absolutely not my type of population I'm talking to. And they are, and I'm okay with that. Everybody has a right to put their money where they want, but it's the type of thing where you're going to have a lot of fluctuations. You can make very rapidly a lot of money, but you can also lose your shirt very rapidly. And I'm going to show this to you in a prospectus of a leverage ETF in a couple of minutes. So on physical ETFs, also to explain, so as I said, that there is not just one, let's say, fully physical replication type of ETFs, but you have sampling methods. So I'm just showing you, for example, you have the representative sample and the optimized sampling methodologies as well. And as said, sampling is something that is acceptable for me, because if you are, for example, tracking an SP 500 with 500 companies in the index, maybe position number 500 or position 499 is so small in terms of risk management that basically maybe you don't want to, let's say, replicate all small and minor changes that are happening in the SP 500 index in your ETF. So that's really, let's say, optimizing the risk and also bringing in cost efficiency, in fact. And then we have the synthetic. So we have the unfunded and fully funded swap model. So you can, and that's why I put them in red, you can understand what I feel about unfunded swap models. I hope that you understand that this is for me really, I don't like the perspective and the logic, the underlying logic of synthetic replication. Except if it would be really for difficult to get financial instruments on, for example, emerging markets where the cost would be actually very high to own those companies. So what is interesting as well, I did not find fully updated statistics for the world, but I found some interesting ones for Europe. And in fact, what is interesting to see in 2024, that in fact most of the European domiciled passive equity assets under management, they are physically, so they follow the physical replication, let's say, logic, while synthetic, it's not huge. There are some, nonetheless, but it's really not huge. So it's less than 1 out of 7 actually, which is a synthetic versus a physical one. And in the physical, you see on the top right, you see that there is a difference between fully, full physical replication of the assets being tracked, so the underlying assets being tracked, and the sampling method. So you see that, of course, and I understand, I don't have necessarily a problem with the sampling method as long as it is really, it makes sense what the ETF provider is making from a sampling perspective. A couple of examples. So this is on the website of BlackRock, so the iShares.com website. So you see, for example, here, this is one of the, if not the most famous ETF in the world, which basically follows the SP 500 in the US, so which represents rough cut 80% of the US public equity market cap. And you see, when you look at the red frame here under bullet point number 1, you see that they are using a sampling indexing strategy in terms of replication. So they speak about it. And this again, when I asked my students, who has read this when you bought the ETF? And 1 out of 2 actually did not. So I was trying to kind of open their eyes on, well, maybe next time if you buy an ETF, please make me a favor, at least read that you know what you are buying. Is it a fully replicated? Is it a sampling, so physical sampling replication strategy that is being used, or is it the synthetic one, or even a leveraged one? Another one, Invesco. So this is one of the top 4 providers in the world. So this ETF is following, in fact, is tracking the NASDAQ 100. And you see, for example, in this one, the top 10 exposures, Apple represents 8.92%. When this was taken, that was January 27, 2025. And you see that they mention as well, in terms of structure, that the replication method is physical, for example. So it's not synthetic, except that we would be lying, but they are not allowed to do that, of course. An interesting one, this is a leveraged one. I want to show this to you. And again, I'm not criticizing leveraged ones, right? There are probably people who are making fortunes with this, and I'm happy for those people. And I'm not judging here. But I want to just to show you that, of course, it requires, and it's what is very interesting, it's actually the same when you buy stocks of a company. I always have learned from Warren Buffett, and I do this since so many years, is go and read the financial report. How many people look at, for example, the changes in accounting policies on a publicly listed company in the financial report? Not a lot of people look into this, but there are very interesting things that are going on when you read, for example, the changes in accounting policies or the auditor's opinion, for example, the critical audit matters, etc., or the cash flow versus the income statement. And actually, even though I'm not an ETF investor, it was very eye-opening because I felt, well, basically it's the same. When you invest into ETF, please read the goddamn prospectus. And here there is one from Direction that I found, which is kind of replicating part of the Chinese market. And what is interesting, you see already in the title under bullet point number 1, so the red one, that is a 3x. So it clearly says it's already in the title, it's a 3 times leveraged ETF. And when you look, in fact, in the prospectus, but I promise you, and I saw this when I was asking, so half of my students, they don't read the prospectus. Half of them read them, so congratulations for them because they are serious. But how many of you, if you're buying into ETFs, are even aware that there are different, let's say, versions of ETFs like physical, synthetic, and leveraged? I mean, I hope that you're doing this. I just want to, again, to do this educational video just to avoid, I would say, any unnecessary exposure because you are not aware actually how to read the prospectus or where to find or what type of information to find. So for example, here you see that on the bullet point number 2, you see, for example, that it clearly says that if an investment in the funds will be reduced by an amount equal to 3% for every 1% daily decline in the index. What is extremely interesting, and I remember I've been discussing this also with my wife, because actually I never had really looked into the prospectus of a leveraged 3x ETF. So this is the red frame number 3, where it says the fund could lose an amount greater than its net assets in the event of an index decline of more than 33%, because it's magnified 3 times. It means that the index would lose 100% of the investment. This would result in a total loss of a shareholder's investment in one day, even if the index subsequently moves in the opposite direction and eliminates all or portion of its earlier daily change. So, so I mean, it's just, I would not say warning people, but at least just be aware and again, be curious when you invest into financial instruments that you read a little bit what is below. And as said, it's the same when you invest into company, read the financial report. So here is read the ETF prospectus. This is one that actually came to my attention because it's one of my students on the Udemy platform. In one of my courses, who asked me, do you know this ETF? And I said no, but actually what is, and I will explain why the student asked me this. So it's a BlackRock emerging markets dividend ETF, a high yield actually. So the last 12 months, this ETF has been generating 11.79% of dividend yield. And so the student actually asked me, don't remember the name of the student, but he asked me actually, Kenny, what's the catch here? And I said, I do not know, but I have to do my homework. I have to look at it. So I looked a little bit at how can an ETF generate 11.79% of, let's say, passive dividends without any, let's say, capital gains on so fluctuation of share prices. And you look on the right-hand side, so just to tell you, the current valuation of the ETF is price to book of 1.02, which appears to me pretty low, price to earnings 7.26. So the companies that are part of this basket, of course this is a weighted ratio, are probably undervalued. When I say undervalued, it's not a solicitation for you to buy, because you need to understand what those companies do. When I looked at the top 10 of the companies, I do know 2-3 companies like Evergreen, China Construction Bank, Petrobras in Brazil. And I realized that, some of those companies, I do understand a little bit what is their business. And I understand that some of them, like Petrobras, they have been, due to, let's say, the Russia-Ukraine situation, we have seen commodity prices going up a lot. And they earned a lot of money, and they have been paying out huge amounts of dividends. So I said to my students, first thing is when you look at the capital gains since inception, so this fund exists now for a couple of years, it only has generated 0.59% in terms of capital gains, which is actually not a lot. Let's be very honest about it. But okay, if this is compensated by an 11.79 dividend yield, but this is just the performance over the last 12 months, right? It's nice. But you have, and I said to my student, even though I'm not an ETF investor, you have to understand how can an ETF, let's say, generate 11.79% of, let's say, passive dividend yield income, of course, always pre-tax. And I said, look at, I mean, if I would have to do a valuation of this ETF specifically on the potential 11.79 dividend yield return, I would actually have to check every of those single companies and check if the dividends that they are paying out, if they are sustainable. So for those of you who are value investors, you know that one of let's say the criteria before I invest into a company is the dividend payout ratio. So I look at if the dividend payout ratio is between 30 and 70%. Because if the dividend payout ratio is 120%, and for those who did my training, the other value investing on Udemy, I remember the McDonald's case, 2016, 2018. At a certain point in time, McDonald's could not continue paying out or burning so much cash just to please shareholders through dividend returns. So at a certain point in time, the amount had to go down, and it went down actually. So as I said to my student is, it looks nice, 11.79%, but you have to do your homework and you need to check if for every single of those companies, the dividend is sustainable for the next 12 months, right? You need to do that. Otherwise, you are just speculating that the dividend yield will continue like this. So I just told the person, pay attention to this, right? And I mean, I do not know if the person did it. The person didn't, I mean, the student didn't come back to me, but again, I mean, there is definitely some risks related to this. There are some banks, for example, included here. I mean, banks, when there is a high inflation environment, banks, they love this because the spread between let's say financing or let's say giving loans to customers and how they put the money at the central bank, the spread in between, so they earn actually huge amounts of money. So during high inflation periods, banks are actually very they have nice performance, in fact, independent now of their cost structure, right? So and I mean, there are a lot of banks and financials that are here. I do not know. I mean, inflation is still there. It's definitely lower than 1.5 years ago, but inflation is still there. We see that, for example, in Europe and in the US, interest rates are going down. But you need to pay attention. So I told just a student, you need to check if the dividend yield that is being paid out is sustainable. So check your dividend payout ratio. And for me, sustainable dividend payout ratio is somewhere between 30 and 70%. So yeah, so this is what I'm saying here. So checking the dividend payout ratio sustainability for at least more than 50% of the holdings of this ETF. So this is now a specific ETF, let's say, assessment on the sustainability of this 11.79 12 months trailing dividend yield. Right, so wrapping up here, I mean, this was a short video. I hope this was useful for you. Maybe some of you knew this, and sorry if you already knew all of this. For those who have not, I hope that this at least helps you a little bit to check, okay, what type of ETFs exist, what's the difference between a fully physically replicated ETF versus a sampled replicated physical ETF versus synthetic. And then you typically have for me, the highest risk ETFs, which are these 2x and 3x. But high risk means also potentially a higher reward. But if there is one final word I would really recommend that you pursue is that really, like a value investor, read the financial report. Well, in this case, if you're an ETF investor, please read the ETF prospectus before investing into an ETF. I think that's really just like good. I mean, like doing a sanity check on where you're putting your money. With that, I'd like to thank you for your attention. Do not forget to subscribe, as I said earlier, to our YouTube channel. Again, thank you, because we passed very rapidly the first 1,000 subscribers on our YouTube channel. And for those who are interested in hearing about VinGPT and the releases that we release for this AI large language model for value investors, feel free, of course, to go to our Discord channel and subscribe to our Discord community. With that, thanks for your attention, and talk to you next time. Thank you. Bye.